Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to be here. We're going to try to help you improve your retirement. Whether you're already retired or looking forward to retirement, there's a lot of things that, are kind of common in both of those areas. So we'd like to do this by answering questions. So sometimes we get questions during our client meetings. You can send in questions live right now. We'll try to answer them. Two ways you can do that. Ask Tom at talkmoneywithtom.com. Send an email, or you can put it into chat as far as that goes. So I look forward to being able to answer the questions that we've gotten and whatnot too. So obviously, we have this channel for a reason. We believe that there's kind of a lack of really, good retirement planning content in the area of asset management, retirement planning itself, and of course, the tax planning that goes along with all of those pieces. So you can subscribe to our channel, hit the button there, and then you can hit the bell button if you want to get notified when we put out new content. And then lastly, of course, if you just want to meet with us, you can do that too. There's a book appointment button up in the corner of our website. Looks just like that. And you go there, pick out a 30-minute time to meet with Ethan and I, and we can answer your questions directly. And so hopefully everybody gets something out of this today. Really look forward to this and hope we enjoy it. I like to start off each show with kind of a summary of what I saw happening this week. And so let me share my screen here. Look at our chart. This going all the way back to 2017 here. We can see, a lot of different activity altogether. The chart is definitely up.
Mm-hmm. Yep.
It doesn't go straight up, as you can tell. That's for sure. We've got, in 2018, that was a little over 19% drop. In 2020, that was a 35% drop. And in 2022, we had a 28% drop. And we're still up, right? So just kind of how it goes. We seem to get a bigger motion one way or another, I think, in the markets, more recently. The big downturns that have happened, like the 2008 downturn, those were pretty infrequent. If you look at the 2000 downturn, 45% down, they were every 35 years. Great Depression, 1970s oil shock, and then 2000. So it seemed pretty. And then all of a sudden we have 2008, not that far, and then 2020. 2020 is a little bit of an oddball one because of the pandemic. It wasn't truly a
Yeah, it was kind of a
economic
blip
event.
in a sense.
Yeah, in a way. But that's kind of how it works, and we'll talk about that some. But this has been a fantastic year. I saw the Vanguard Total Stock Market Index is up, in the 30% range for the year to date. And that's kind of the whole market, including the small cap stocks. And the S&P 500 is in, the 26% last year, looks at 28% this year. So this week, it looks like it might be down. It depends on kind of what happens today. But we're down Monday, Tuesday, and we were up quite a bit on Wednesday after the inflation report came out. So the CPI report was reported on Wednesday morning. And so this is not the main inflation report the Fed looks at, but it is the last one before the Fed meeting next week. So it was somewhat important as far as that goes. It came in at expectation. I didn't think it was a great report. It was a little bit higher than the month before on the top line. Inflation, it matched the month before, year over year on the core inflation.
Yeah, a lot of people were saying the underlying factors were kind of where people were getting some kind of hype for, I would say.
Yeah, exactly. And so it's a just another piece in the puzzle. I did see, though, on Wednesday, the market, the futures market that kind of bets on, Fed rate cuts went from about 85% to 96% chance of a 1/4 point cut. And just so you kind of understand that, January is the next meeting, and there is an expectation right now, looking at that futures market, that there will be no rate cut in January. And then March, right now, the expectations is that there would be another 1/4 point rate cut. So, we'll see how that plays out as far as that goes. There's lots of data that's coming in. But overall, the economy is doing quite well. Inflation is, down there, still not falling down to that 2% level.
It may take some time. It's not going to just free for all to the 2% like we wanted to.
Yeah, they've talked a lot about how the last mile, kind of getting from this 2.7 or 2.8 or wherever we are right now on core PCE inflation, getting that last mile down to 2% is pretty tough. But you have to understand that the Federal Reserve really doesn't like it to be under 2% either. So that's why we're seeing rate cuts now, because again, they take 3 to 18 months to really have a significant impact on the economy. And so they don't want to leave rates up, in theory, to be able to, make sure that they don't end up with a recession or a
Big
situation.
unemployment, yeah.
Yeah, unemployment going up quite a bit. as far as that goes. So we did get first-time unemployment claims this week. They come out every week, and they were higher than expected. And so, we'll see what happens. I think that again, that just gives the Federal Reserve another reason to lower rates next week. And so it would be a very big surprise, I think, to everybody if they didn't. And they've been signaling that they're planning on doing that rate cut in December. So I don't think that's going to change that much. Uh, and so, when we look at these things and we look at kind of what's going on, market wise, one of the things that's always interesting to me, the market is all about supply and demand. And at the end of each quarter, these very large funds of all types, the target date funds, these momentum funds, they rebalance,
Hmm.
right? And so you'll see some volatility oftentimes. And then when you get to the end of the half year, you've also have more funds that might be rebalancing once every 6 months. So that's the same thing here in December. And my experience in December has been that December is a good month, which historically has proven out to be true. It's not as good as November, it's not as good as April on average, but a good month. And what I have seen though is softness in the middle of the month a lot, and I think it is because of this rebalancing. So we're talking about all these different things and trying to attach news to different motion. And yet, December after December, I have seen kind of this, at least volatility, small drops, those types of things that are happening. So if you've got a fund, let's say that's supposed to have a certain target of bonds and a certain target of stocks, and you've had this last 6 months, stocks have outperformed bonds by quite a bit. And when you rebalance, you're going to be selling some of that stock and buying some of those bonds,
Hmm.
right? And so, that's where you kind of see that. You really kind of need to ignore that, in my opinion, because every time it finishes, usually in this case, around the 27th, 28th of December, uh, it takes off again and it starts to go. So, obviously there's a lot of uncertainty about next year, just in terms of, what policies are they going to do. There's the rhetoric of the campaign and then the actual, things that are going to happen. How are those things going to affect the stock market? Are they going to be able to do tax cuts? What do those tax cuts look like? Or even just extending, the current tax brackets
Hmm.
that we have from 2017. And we are seeing a bump in kind of that big cap tech stock. Uh, I don't know if it'll hold up. We'll see. But oftentimes, when there's uncertainty, that's when those stocks tend to do well, at least outperform. So, in that big drop in the pandemic, the Apples and Microsofts of the world didn't drop nearly as much
Hmm.
because, again, people are still trying to stay in the market. The big money likes to stay in the market, but they're going to go maybe to these companies that can survive more things than the other companies. And so, I'd be interested to see if that trend continues here, if we continue to see kind of large cap tech continue to do well on a relative basis. They led this rally. Again, they're the first thing that comes out of the rally because they're the place people are putting money because they're
Hmm.
not sure about the rally yet. Then once we're sure about the rally, we start to see a breadth, increase. Mid caps doing well, small caps doing well, value stocks doing well, and we'll see relative underperformance of the large cap tech stocks, which is what we saw for a big chunk of this year, right?
Hmm.
At the very beginning, great run on those big cap techs, and then here for kind of the middle to the end, we've had some softness, but it seems to be picking back up again. And I wonder if that theme will continue. I wonder if it'll continue into next year until we kind of get some better ideas of what's going to happen and how this is going to play out as far as that goes. So again, fantastic year. I've had some questions about, okay, we've had 2 good years. Is it time to be selling? Is it time to, get more conservative or those types of things? Um, I found this chart. Oh, it's not changing. Bummer. All right, so let's try go back to here. Go back to here. Nope, doesn't change.
Okay.
Hang on a moment, folks. We got a
Little tech.
tech issue here. Sorry for the delay. This is actually a pretty sophisticated studio. We have a lot of different things going on. Sometimes they sometimes they don't work. But this is a chart of rates of return on the stock market going back to 1930, and it's pretty amazing to look at this actually. If you study it, even a little closely, if you see the last two bars are the last 2 years, and we've done better this year than we did last year. Last year was fantastic. This year's been even better. So if you look, there's 18 times where you had at least 2 years in a row where the market went up. Out of those 18 times, 11 of those 18 went on to at least a third year, if not more. So on a probability basis, just looking at historical norms, we should have a chance of a third year being at least positive, right? As far as that goes. And there's some really big runs in there where it's 4 or 5 years where it's positive, and those types of things too. And matter of fact, their last really big run there was leading up to from 95 to 2000. And again, we've been talking about kind of the similarities of that run and this run. I mean, today Broadcom was up, what, 20% after their earnings report?
I think it's up to 25 now.
25%. So, and they're running on the artificial intelligence. They have a lot of chip company access and software. They're a big company with lots of different components. But that's the the outlook of what might be happening for them with artificial intelligence. And so that's the same type of things that we saw. So again, if this continues to play out like a normal bull market, or even more so like the 95 to 2000 run, next year we'll get a bit more frothy once things settle in. I mean, imagine a tax cut, corporations go down to 15%, or deregulation, or any of the things that the market seems to think are good things, and all of a sudden you're having another rally come through. There will be IPO. In my opinion, IPO market will start next year, maybe in the second half of the year, and then of course in that total look at what might happen, eventually it gets nutty. Yeah, and so you'll start to get more and more IPOs, many of them not making much sense, crazy little things that are happening, whatever. At the end of 21, it was the SPACs. At the end of 95, 2000 run, it was the crazy little .com companies. Didn't even have a product, no revenue, no nothing. They just went public, and saw pretty significant gains. So, that's the process that could play out here. I think it'll be interesting to see, what really does happen as far as that goes. But it has a chance. The probability is that we will do well next year. That's just that. You look at the economy, you look at the stock market, you look at the history of the stock market, you look at the momentum of the market. The momentum is not slowing down at all. Actually, it's if anything, if we look at this chart, that run from last summer of 2023, October 27th there of 2023, that's a pretty significant run. I mean, that's a very smooth looking chart. We had a drop in April, we had a drop in August this year, right? So we've had some downturns, but really not a lot of dips. And the dip buying is coming in like earlier and earlier, which is a good thing. So anyway, that's kind of what I see happening here. It's anything can happen. They can really mess up with these different policies that they're talking about and really mess up the market. I can see that as a possibility on the downside. You can always have some geopolitical things that happen that have an actual economic impact. Like Ukraine was a drop to the market up front because the fear was that that would have an impact on oil. Yeah. And so that impacts the overall economies. Taiwan and China situation, if something happens there, that's an impact on probably something even more important than oil at the moment, which is semiconductor production. And so, those are always out there. They're always, a possibility. And most of the times, it's actually the worst things that can happen in the market are the things that we're not talking about. The market was down 20-some% in 2008 downturn, and then Lehman Brothers failed. And again, that wasn't something we were talking about. We were talking a little bit about credit default swaps at that time, but didn't realize the full impact of it until later.
How many companies had it?
Well, yeah, it got to $7 trillion in like 7 years. Amazing, because a private market, there was no real way to track that. And so anyway, there's always something that can be happening in the background. However, as an investor, you kind of have to be able to see, first of all, you got to see the positive to outweigh that negative. And then you kind of have to understand just, what's the history? How does this thing normally work? Because this stock market is a representation of human emotion.
Yep.
And human emotion doesn't change dramatically year over year. 2025's human emotion equivalent, for this entire world of people that invest in the stock market isn't going to change in 1 year period. Maybe there's some human emotion change over a 100-year period, but that's what makes that look back at some of these trends to be somewhat useful, because it's operating under the same guise of these group of people. And I would say, if anything, it's improved to a certain degree because of number one, there's more households that have exposure to the stock market than before. And number two, there's more money coming into the stock market on a monthly basis, which I think can support the market through these 401k contributions and matches, right, which has become very, very large. And so, I think some ways that's created some volatility out there also. We've had more of these downturns, since 2000. We've had more 20% downturns, than normal, and that could happen again. But this particular market is not like what we've seen for quite a while. This is a pretty good market. I mean, these are pretty solid companies so far that are really gaining. So anyway, look forward to seeing what's going to happen next week. We won't have a show here. This is our last show for the end of the year. But for the most part, I'll still try to do the summaries on Fridays, so everybody can kind of hear what's happened for that week as far as that goes. But all right, good. So let's get into our first question.
Which year of income applies to the 2024 IRMA, which is the income-related monthly adjustment amount bracket, which for Medicare premiums?
Yeah, so most people that have Medicare probably understand this, but it's really interesting. So what happens is Medicare is means tested, which just means that you pay a base amount for Medicare, and if you make a certain amount of money above their limits, and I have that chart here, then you end up, paying more. And so here's the chart for 2024, for example. So if you're at 206,000 or less, and they have a kind of a special calculation for how they figure this out.
Yeah, they have
actually.
Even though they say the modified adjusted gross income, their calculation is different than the one that you see in your tax return.
Yeah.
And so it's a slightly different calculation.
Yeah, which is too bad. This makes it all that much more confusing. But nonetheless, 103,000 for single filer. If you're under those two levels, at least for 2024, you're not paying anything extra over and above the normal premiums for Medicare.
Yeah, and the IRMA the IRMA brackets essentially are linked to CPI, and so next year they're going up about 3,000. So for single it'll be 106,000, and for joint it'd be 212.
Yeah,
and so you can if you kind of want to estimate, you could take maybe a 3% or 2%, kind of if you want to make a guesstimate. But as long as you're below a bracket for the current year, you'll be below that bracket again if you have the same income.
Yeah, because that's the tricky part here. This is really interesting. They look back 2 years. So here we are in 2024. Mm-hmm. And let's say that you had $209,000 worth of joint income under their calculation. Well, theoretically, you would have jumped into the next bracket. You'd have to pay an extra $69.90 a month. Of course, that'll be different too by the time we get there. But so it's really confusing, because what they're doing is they're looking back 2 years at the income that you had, and applying the 2026 brackets, which we don't really know what they are.
We can make educated guesses, but we really don't know.
Yeah, this comes into play more often with the Roth conversion. So you're trying to figure out how much you can convert and stay underneath, the brackets, but the brackets are unknown. If you stayed under 206, very likely that by 2026 it'll actually be higher. 212 or whatever it might be. And so you're safe if you stay under the brackets for that year. But in theory, if you really wanted to maximize it, you could guess and say, let's say it's 3% inflation for 2 years. I'm going to go up to 212 or whatever. One of the problems with Medicare, on normal taxable brackets, if you go $1 over the limit, only that $1 is taxed that higher rate.
But Medicare is a little bit more punishing in a sense. If you go that $1 over, for that rest of the year, you have to pay those extra premiums.
That's exactly right. Now, they get quite high, too. I mean, it's $419.30, for for this year at the highest level for an increase cost for Part B, an $81 increase for Part D. So if you have a real big windfall in one year, selling a house would be the thing that comes into my
Yeah.
mind. You're going to have 2 years later, you're likely going to have a higher uh, cost for a year.
Yeah, and the nice thing is it adjusts every year. So you
Yeah.
could have if you have 1 year of high cost, it'll adjust the next year.
I think the really nice thing here that should never be ignored, we have a lot of clients that are paying for private insurance on their own, and they either retired early or they have their own business or whatever it might be. And the cost of private insurance versus the cost for Medicare, I don't know, 2, 3 times higher.
Yeah.
Even at the higher level, it's still roughly 2 times higher for private. So Medicare is still a deal. It just gets to be kind of painful for people. They're used to paying, a certain amount. All of a sudden, they're paying a lot more, and it gets into your head. But
Yeah.
it's still cheaper than other systems, and it seems kind of fair in a way. I mean, making the brackets are pretty high. I mean, 206,000 for a couple. That's a pretty decent income, right? So it's not affecting a lot of families, which I think is a good thing. And Medicare is well received, at least within our practice. People really like it, and they should. I mean, it's a good discounted healthcare program altogether, in my opinion. So it's a really good question. So just to answer the question again, if I have 2024 income, and it's too high, I'm gonna possibly pay extra Medicare costs in 2026.
Correct.
But they're going to be applying, the brackets from 2026 to my 2024 income.
Mhm.
So I don't really know for sure until I get to 2026 whether I have exceeded those or not, if I'm close to the edges on some of these little brackets. So, to answer that question directly, so I'm not sure why they do that. It would have been so much easier to just say, okay, 2024 you were over, then you'll have to start paying in 2026. They just have a 2-year gap, right? And so fine. That's I don't get why they're applying 2024 income to 2026 brackets that we don't even know what they are.
Yeah.
Yeah, I imagine there's some reason for that.
I think
Some
it's
logistical
because
thing that they've got that they deal with.
I think it's because we prepare taxes in 2020 the next year.
Yeah.
And so it'd be hard to give you that tax bracket the same year in that sense.
Yeah.
So there has to be some sort of lag. And a lot of times,
You can still do the lag though. It's just a matter of where you apply it, right? So you can still say, okay, we're going to give the lag. You have to pay in 2 years, in 2026. That gives us time to do the tax returns and everything. But that way, I will say though, if you just stay under the 2024 bracket, if you
Yeah,
have
you're
a
on
choice,
track.
you're good because
Yeah.
it probably goes up by 2026. So that's a good fallback position. And anyway, but it is kind of an interesting concept. That's for sure. All right.
so
What's our next question?
does adding or removing a company from an index, affect the stock price?
Yeah, so that the S&P 500 or whatever it might be, right? There's 500 stocks in the S&P 500. They get replaced on a regular basis. Matter of fact, there's 30 stocks on the Dow. They get replaced too.
Yeah,
right?
I think Intel was part of the recent removal.
Yeah, and Nvidia came in to the Dow, right? So we've got an example here of the Nasdaq 100.
Yeah, I think it was sometime, it was announced this week essentially.
Yeah, so Nasdaq 100, you can buy one of the ETFs that replicates that. It's QQQ is the
It's a very
ticker
common
symbol.
ETF. So.
Yeah, it's very popular, and so you can see the grouping on the farthest away from me there is the ones that are being added, and then the next grouping that's just right over my shoulder are the ones that are being subtracted. So Moderna, Supermicro, Biogen, CDW, etc., are all being removed from that. And you can see the rates of return through December 11th, kind of year to date. And Moderna, is struggling down 57%, and Biogen is down 39%, et cetera. So what impact does it have? Well, they're trying to put the companies that are really moving and really doing, and you look at the rates of return,
Yeah.
some of them are crazy. So,
It kind of compounds
here.
the momentum that's
Yeah.
going on.
Yeah, so it helps those companies because what's happening is there's billions of dollars in these indexes, and so all of them are going to sell those stocks that are over my shoulder and buy those stocks that are in that first grouping. And so that's a great thing for these stocks. It's actually a really big deal to be put onto some of these indexes. Because especially in today's world, there's an awful lot of index investing. In the past, that wasn't so true. The indexes were just kind of hanging out there. But the advent of the mutual fund, Vanguard really starting the S&P 500 index concept. I remember that started in 1975, and I read a lot of stories about it, and they thought it was the most foolish thing ever. Why would you do that? Because everything was about finding the stocks, and well, and unfortunately, they keep winning, even without finding the stocks, just buying the index, and so then you can make it a lot cheaper. And so that's kind of the advent, and that's what we've been doing since '98, something along those lines. We've been using ETFs in an index investing environment, and so it theoretically helps the index because you're now putting in companies that have some momentum behind them that are going the right direction. So if you look at the Dow, rather have Nvidia definitely in there than Intel. Intel's struggling. That could change. But that's why these things do change. They don't change a lot. And this is 100 stocks in this index, and how many are changing? What it looks like
11.
11.
Yeah. I think this is a bigger year too. Usually they say it's like 5 to 7.
Yeah.
So
Yeah.
depending on how big of a year with increases or not,
Right.
it's going to change.
Yeah. So that's how it works. Replace those stocks. The stocks that are moving out will probably drop even further. The stocks that are moving in will probably go up even more because that money's coming in. Overall, the impact on the index is to try to keep it moving in the right direction with companies that are doing well. Because you would have wished that, some of these stocks would have been on there, like MicroStrategy, which is up 551%. That would help that index. Now the indexes are impacted by capitalization, except for the Dow, which is actually weighted on price, which is kind of weird. Which is why probably Nvidia did that big split.
Yeah,
so
to allow them to be on
to match up with the Dow, pieces that they needed to. But nonetheless, like the Nasdaq 100 that we're talking about right here is weighted based on size of company. So some of these companies are quite small, and they won't have that much impact. But it adds up pieces as far as that goes. So anyway, that's good question. It's kind of an interesting area. It's something that happens here at the end of the year.
Different indexes rebalance on different times. So usually what the Nasdaq 100 does is they take the end of November, they take it and they announce it usually the second week of December.
Yeah. Sounds good.
So why has core inflation been so sticky? When you look at CPI, it's been 0.3 month over month for the last 4 months.
Yeah. And so, obviously, if you annualize that out, that's 3.6%. I think it's at 3.3 right now, year over year. So it's, and then of course I've got a chart here of core PCE over the last 3 years. So this is the one the Fed looks at, pretty heavily.
Yeah.
And that's been sticking around this 2.6 to 2.8% year over year since over the last 6 months now.
Mm-hmm.
So again, they talk about the last mile to kind of get down to this 2% range is the hardest. But I think one of the biggest drivers, especially in core inflation, has been rent, right?
Yeah. For CPI, rent makes up, I think to be exact, is about 36, but most people around to 40%.
Yeah.
And for the last 12 months is 4.5 or 4.7%.
4.7% growth on rent year over year.
Yeah.
Nationally, of course. Now both have different measures of how they measure rents. The CPI has what they call the owner's equivalent of rent, and so it's a little different. But both of them are rent is factoring into both of them, regardless of the way that they're calculated.
Yeah, and both PCE and CPI, rent is always kind of a lagging indicator compared to the private market.
Yes.
It's because when people rent, you lock in a price for a year, 12 months or more. A lot of the times, you don't do month-to-month rents.
Right. Yeah, exactly. It is amazing because rents have been growing at a higher rate than inflation for quite some time, and the cost of housing being what it is, mortgage rates being higher, so it kind of eliminates more people from being able to qualify for a home. And so that leaves renting as an option. Mm-hmm. There's a movement out there, to not buy homes and just rent, and some pros and cons to that. Really depends on where you live, too, as whether that's a good idea or not.
Yeah, and there's a rent to ownership ratio that a lot of people say, and so sometimes, depending on what the situation is, it may be better to rent.
Right.
The nice thing about housing is you diversify when you buy a house in a
Yeah.
sense.
Yeah. Exactly. Yeah. So it's kind of a forced savings plan. As you make a payment, part of your payment goes to principal, and that principal just continues to drop and drop and drop as you make those
And then you
payments.
also have
Yeah.
the just the house appreciating too.
Yeah, you hope so. Yeah, I mean, it doesn't happen everywhere, but yeah, exactly
That's
right.
the hope. That's the
Yeah,
hope with real estate.
exactly. So it's a good question. I think that altogether, um, I'm actually slightly concerned about inflation coming around. I mean, you just saw what a 26% gain in last year, 28% gain this year in the stock market. That emboldens a lot of people,
Hmm.
makes them feel, that they have wealth. It's why the Federal Reserve was so anti-stock market in their commentary during the period of time when they were raising rates, because they wanted to knock that down. They wanted to scare the market as far as that goes. So, now they're not doing that, and we'll see what happens. Some of the things that they're talking about for the administration for the next year are, in my opinion, inflationary. The possible deportations and the
And
tariffs are the
you've
two
seen also
biggies.
sort of with the futures market how they're only doing quarter points, and
Yeah,
they're also in January they're also not doing any.
right.
They're predicting no cuts, so you
That's
can
right.
kind of see the slowing in a sense of
Yeah,
the cuts.
yeah. I think there's some. They have to be careful. The last time we had this high of inflation was back in the 70s, right? And they started they raised rates. They got inflation coming down. Then unemployment started to come up, which is their other mandate. They went ahead and started lowering rates, just like we're doing now. And then inflation got out of control. I mean, really out of control. They had to raise the Fed funds rate to 19%.
They had to break the economy essentially.
Yeah, we're at 5 now. I mean, roughly 5. So,
Yeah.
and so that is in the back of their minds. Chairman Powell has talked about it several times. And so again, we haven't had this type of inflation since then. We don't want to repeat the same things that are happening then. I Of all the things that are out there to be worried about, the new administration or whatever, I really think inflation is the key thing because it is sticking it here. It hasn't, we've been pretty used to for a while here that thing coming down month after month
Yeah.
for the most part. And now for 6 months, we've been kind of sitting around the same. It's even slightly higher. It was
Yeah,
2.6, now it's 2.8.
this is one of the first months where actual shelter and rent for CPI has come down.
That's good.
And so the shelter year over year inflation is at the lowest level it's been since 2021.
Yeah. Yeah, and we had first time unemployment claims come out higher than expected. It was 242,000 jobs or people applying for first time unemployment. And so, a little softness isn't terrible if you're worried about inflation. Too much softness creates a recession, which you don't want either. And that's that Goldilocks zone. And we've been in that zone for a long time here. I just would like to see that inflation continue to come down some more here.
And the Fed maybe be happy with like a 2.4, 2.2, like
Oh
slightly
yeah,
above the 2. 2 is kind of, they've been saying that as their goal, but if they had a little bit above, I think they'd be okay.
I don't know. I think their range is 2 to 3. That's what's been recommended by so many different people. I only say that they've never said that.
Yeah.
But if you listen and you watch, and I've been watching all the Chairman Powell pieces, after every meeting and listening, and the tone has changed quite dramatically. They seem quite satisfied with where this is right now, in my opinion, and they're willing to do rate cuts here and don't seem to be bothered by the little upticks that we've had, in the last couple months. So well, because the 2% was just basically pulled out of a hat,
Mhm.
yeah, a long time ago. So there's no real justification for being at 2%. 2 to 3 is not a terrible place to be as a range because you get down to 2, all of a sudden you could be at 1.5, which is what happened, and then you're starting to flirt with deflation, and you've got some other issues to deal with. So anyway, that's what's happening in that area. So hopefully it does okay. Right now, it's actually doing great. I mean, it doesn't need to come down per se. It just needs to not go up.
Yeah.
Yeah. All right. What's our next question?
Should I be timing the market with my Roth conversion? The market's all-time high, but usually in December I do my Roth conversion.
Yeah. So a Roth conversion is you have money in an IRA or a 401k or some type of tax shelter, and you want to convert that into a Roth IRA. Your regular IRA or regular 401k, what have you, traditional, what they call them, is tax deferred, just means you're not paying any taxes. And then a Roth, of course, grows tax free. But as you pull that money out of the account, it's taxable. And so, you're basically prepaying your taxes before you're being forced to, past 73 now. You have to start taking money out of those accounts. And so when do you do it? So most of the times it's being done at the end of the year, only because we want to make sure we know as much of the income story as we can. How much do you have in interest income? How much dividend income? How much capital gains do you have? What earnings do you have? Do you have Social Security? Is there a pension? What have all of those pieces come in? So we're not being surprised by it, and then we'll know how much to convert. Because generally you want to convert within certain tax brackets. For the most part, 24% or less.
Yeah, 24% or I believe the 12% if you're in that low bracket are kind of the two sweet spots for the jumps.
Yeah, so you don't particularly want to convert more than that and end up paying 32% because there's a pretty big jump between 24 and 32.
Yeah, the nice thing is that it's only the amount you go over, so it's
Yeah.
not like too punitive by going over too much.
Well, we're also balancing out with a lot of our clients the Medicare, IRMA, which is the, basically formula that they use to figure out how much you're going to pay on Medicare, to try not to trip those levels. So that, you're trying to balance these things at the end of the year. But let's say, for example, you're pretty sure you can do, 100,000 or something, and all of a sudden there's a big drop in October. I might use that, and we have had clients use those opportunities to do either the full 100,000 and just take the chance, or part of it.
Yeah.
70,000 or something along those lines. So if you know you're going to do it during the year, and so this year we had drop in April, we had drop in August, right? Those would have been two chances to, hey, the market was down 8.8% in August. Okay, let's do our conversion then, or at least part of our conversion then. So yeah, I have no problem with that at all. It's generally speaking, the best time to do a conversion year after year after year would be right at the beginning of the year, because then you're getting that tax-free growth for that year. The stock market averages a positive rate of return, and it has more up years than down years. So, you would have been better off doing January, but it's really hard in January to figure out what to do. Again, you could do a small portion.
Yeah, but it's hard to figure out your income in
Yeah,
January for the next 12 months.
But again, if you did a rough calculation and you look like you could do 100,000, you could do 25 in January. So there's some strategies to look at. I think these are kind of fine tuning, icing on the cake type strategies. Not as important as actually, doing the calculation to figure out whether a Roth actually conversion works for you. For starters, those types of things. But there are some strategies to use, in terms of what you're doing. And again, same thing with these required minimum distributions. People tend to take them at the end of the year because, again, they're allowed to let it grow. On average, the market grows. So
The only problem is you have to take your if you're an RMDH and you want your Roth conversion, you have to take your RMD before you do your Roth conversion.
yeah, that's going to be really fun. So if you want to do that 25,000 out of that 100 that you think you might do in January, you're going to have to take your R&D in January first before you can do that 25. And again, that's assuming you're at the age where you're getting an R&D. And that's why it's so great to do some of these things, Roth conversions and what have you, earlier in your retirement if you can, because that's what it's designed for, in my opinion, is to try to help lessen the impact of these required minimum distributions.
Yeah, a lot of people say if you want the absolute sweet spot, it's like 60 to 63 because then you don't worry about IRMA for your Medicare and you can do your conversions. But a lot of people do it, just try to do it before Social Security.
Yeah, exactly. Yeah, there is a window. I mean, because while you're working, your tax bracket might already be above 24%, so it's hard to put money on top of that. And then once you stop working between that period of time and Medicare coming, that's a really good sweet spot because you don't have to worry about the Medicare at all. And then, between Medicare and 73, so 65 to 73, you just have to kind of manage two things, the tax brackets and the Medicare brackets, which is not impossible. You just keep going, with
Yeah,
it.
that 70 to 73, you have the Social Security addition too in there
Yeah, exactly.
for your income.
Yeah, that's right. All right, good. What's our next question?
What should I do if my QCD check isn't cashed in time? And so in time means by the end of the year, so December 31st, 2024.
Okay, so QCD stands for Qualified Charitable Distribution, and this is for somebody who is currently taking out money under required minimum distribution?
Usually, the age actually hasn't changed, so they kept it the original.
Oh, that's right. So it's 70 and a half. You can start doing QCDs. That's interesting.
But
I don't know why they make it so complicated, but
yeah, but essentially, usually you only use it when you're taking RMDs.
yeah. So what happens is, let's say that you're required to take out an RMD for $10,000. That'll end up on your tax return, right? So you can directly give money to a charity. Let's say in this case, $5,000 just to make it up. And so I'm going to give money. I already give money to charities anyway, but because I don't itemize, and a lot of people don't itemize anymore because the standard deduction is so high. I'm not actually getting a write-off anymore for that charitable contribution, which is fine. You're doing it for more than the write-off, I would assume. But you can still get a write-off once you start having requirement distributions. Because if I give away 5,000 of that $10,000, I only end up with 5,000 on my tax return.
Yeah, so they only count the income that goes to you.
Yeah,
And
exactly.
you have to also tell your tax preparer that you wrote this check of QCD.
Yeah, that's a big one.
Let's
Repeat it. So you have to tell your tax preparer that it's not on any of the forms. The tax preparer is going to see a $10,000 distribution. He or she is going to put that on your tax return unless you show them or tell them, hey, I paid 5,000 to these charities.
Yes.
Right? Okay, so that's important. So then once we've done that, then we've got a scenario of, okay, how do you do it? There's two different ways. You can write out a check and get a checkbook from your IRA, and you just start writing checks all year long. But the question is, what if I write one out that doesn't get cashed before next year?
Yeah, so if it doesn't get cashed and you still have an RMD left, you have to figure out a way to distribute. Otherwise, you're going to pay a 25% penalty on that.
Yeah, so let's say I write a check out of my 5,000, $1,000 to this one, and for some reason they didn't cash it, or I sent it really late and they didn't have a chance to cash it or whatever. I now have only $4,000 of my money that has been gone to charities. Instead of taking out five, I've got to take out six.
Yeah.
All right. Only other caveat is you could contact the broker dealer or a custodian like Charles Schwab and have them directly issue a check. If they directly issue it, they credit it to you. And just to be very clear, the money cannot come into your checking account. You cannot write a check. You cannot have money transferred to your checking account and then write out, because that's a distribution to you. Mm-hmm. The whole thing works around the fact that it has to go directly to the charity, either through you writing out a check. So there's advantages to writing out a check. It's simple, it's easy, you don't have to fill out any forms, you just do it whenever you see it, it's more flexible. Disadvantage is it has to be cashed in order to count.
Yeah, the only problem is writing huge checks this late in the year is there's just a time crunch.
Yeah.
Especially, so what I would say, if it's not cashed by the 23rd, just distribute the money. Charities aren't going to be working after Christmas usually.
Yeah, that's
so
a good point.
you want to just get the distribution, and if it gets cashed next year, it comes off next year's RMD.
Right.
It's unfortunate that it didn't come off this year, but it is what it is.
Yeah, exactly. Now, the way around this, for starters, is to start earlier.
Yeah.
We get a lot of clients that are doing this in October, November, which is pretty good, should be okay.
Yeah.
But honestly, I'd probably do it in March. And just because you want to make sure it's going to cash and you can track them and see if it got through. There's been lots of little problems with different things that have happened. They changed their mailing address, or they lost the check, or whatever. So it'd be nice to know that in advance.
Yeah, and so charities also they get all the money at the beginning, at the end of the year, but you could help them out in a low period by doing it a little bit earlier too.
Yeah,
but it's not like a usual charity cycle.
Yeah, they can still use it in March as well as in November, and so being a little bit proactive, it just makes it easier as far as that goes, in my opinion. Okay, that's a great question. That's our show for the end of the year show, I guess, and so we'll be back starting next year. I want to thank everybody so much for coming. Please feel free to send in questions. We get a chance, to look at them, send them through the email, asktom@talkmoneywithtom.com. You can go to our website and subscribe and hit the bell button to get notified for new content. Start watching some of the pieces that we've done. I mean, if you really want to up your educational level on how things work in retirement, this is a place to go, in my opinion. We've been helping out for years and years here. And of course, you can just meet with us directly if you'd like. You can go ahead and book an appointment, and we can help you with whatever questions you might have on a personal basis. The button for the appointment looks just like that on our website. Set up a 30-minute time to meet with us, and we'll be happy to meet with you. All right. Well, thank you very much for coming. I look forward to seeing you in the new year, and have a great holidays. Thank you.